Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast. I'm Matthew Sewick, also known as the Friendly Financial Coach. So today, we're going to begin with a question. What would you do if all of your investments dropped by 15%? 30%? How about even 50%? Would you panic, wait it out, or even notice? So as you may have guessed, today's episode is about investment risk. Before we can really talk about risk in detail, we really need to understand what it means in our context. In the financial industry, risk is defined as the variability of investment returns. A basic expectation of investing is that we expect higher returns for higher risk. The extra return that we desire for this volatile investment is something that we call a risk premium. But before we can really explore this further, we actually need to pull back and understand the amounts of risk that you feel comfortable with. The reason why this is so important is because your future investment choices need to match your risk profile. If your investment portfolio is too risky, then you're very likely to have some sort of anxiety and in extreme cases, even pull all your investments out. This is something that I actually see fairly frequently. At the same time, the reverse can be true. If you take on less risk than you could actually tolerate, then you will not achieve your full investment potential. While it can be complicated to determine your comprehensive risk profile, a good trick is to simply visualize how you would feel if your investments dropped in value and how you would respond. So ask yourself, how would you truly feel if your investments dropped in value? Now, this is a big question because if you do invest in volatile investments like ETFs or mutual funds, then your investment portfolio will drop in value many times during your life. And you need to feel comfortable with this. And it's important for me to say that there's nothing wrong with choosing safe investments. Unfortunately, in the financial industry, this is mildly frowned upon, but in reality, you have to choose what works with you. There's a romanticism with risky investing that can easily entangle people, but you really need to pick what is true for you. Research has shown that age, gender, current financial position, investing history, and more affect your risk profile. Now, before we move on, I recommend that you pause here and reflect on how much risk that you feel comfortable with. So, shifting to the nature of risk itself, in finance, we broadly categorize risk as being systemic or unsystemic. Systemic risk refers to the larger system around us and includes overall market conditions, broad economies, cyclical fluctuations, and more. It's generally deemed by investors that these conditions are beyond our control. Examples of systemic risk are inflation risk, recessions, and more. A mathematical term called the beta is used to try to quantify this value. On the other hand, unsystemic risk is not explained by the market and is instead unique to each asset. So things like the risk of having a company going bankrupt or having poor performance is considered to be related to the company itself. A recent example of unsystemic risk is what's happening with Hydro One in Ontario. So Hydro One is owned by shareholders and the government of Ontario. The new Ontario provincial government had an election pledge to fire the CEO and the board of directors. And just this week, that's what happened. From when I'm recording this podcast, the stock had already fallen by over 4%. This is a specific example of unsystemic risk because just Hydro One has been affected. Thankfully, unsystemic risk can be reduced and nearly eliminated through diversification. One of the easiest and most popular ways of diversifying is by using ETFs and mutual funds. These funds can hold hundreds of individual stocks, which reduces the risk of a single company failing. Digging deeper past the broad categories of systemic and unsystemic risk, we can categorize even further. Inflation risk is a big one. This is when increasing cost of living degrades the values of your investments. There's also liquidity risk. This is when there's uncertainty of reselling your asset. Cash is typically the most liquid when tangible assets like paintings, collectibles, and in some cases, real estate have high liquidity risk. Exchange rate risk is one that you will need to consider if you own any investment that is valued in foreign currency. The last one that I really want to talk about is country risk. This is when there's uncertainty that is connected to the political or economic environment of a country. An example of this is when a foreign government seizes assets. So that's it for today. But the most important thing to take from today's episode is what type of risk that you feel comfortable with. This is a point that we're going to be constantly reflecting for the rest of this series. So thanks again for listening. If you have any questions or have any future episode recommendations, you can contact me by email at info@ffcoach.ca, or you can find me on Twitter at @f_f coach. Take care and talk to you next week.